Hello and welcome to my channel. This video is a part of NISM Mutual Funds tutorial. I've already covered chapter 1 to 9 of this playlist, so I request you to watch those videos as well to get a better understanding. You can get the link to the whole playlist in the description box, at the I button as well as at the end of this video. For this particular, we will be covering chapter number 10, that is risk, return and performance of fund. This chapter is quite a lengthy one, so for this video I have covered only part 1 and part 2 I will be explaining in another video. So now let's start with this. If you like this one, do hit the like button and do not forget to subscribe to my channel. Now let's start. So as we saw in the title that this chapter is going to be all about the risk, return and the performance factors related in mutual fund. So not just mutual fund, when you are making any kind of investment, there are two major criteria on which you judge your investment, whether you should invest or not. Those two major criteria are the risk and the return. Okay, so you just see that how much risk is involved if you are investing your money in any particular asset class. At the same time, you also assume that what return percentage you can get. So the same applies in the mutual fund case as well. When we are investing in mutual fund as an investor or as a fund manager, there are different types of schemes being presented to the investors, and one has to decide that what is the risk parameter involved, what could be the expected return. Though the return is not fixed, we all know that it is subjected to market risk and there is volatility and all, but still we try to judge on the basis of past performance, on the basis of asset class, that what could be the expected return percentage of our investment. So these two factors are going to play a major role in this chapter. In this particular video, I will be talking only about the risk factor. In the another video, we would be learning about the returns and the performance of the mutual fund. Okay, so now let's just see that you can classify risk factors into two major categories, general risk factor and specific risk factor, as given in your NISM module. So general risk factor, we would be learning about liquidity risk, interest rate risk, reinvestment risk, political risk, economic risk and foreign currency risk. Now these are the general risk that is involved in investment, which is also applicable to the mutual fund investment. But if we want to categorize it specifically, we can divide it as risk associated with equity funds and risk associated with debt funds. So we know that there are two major categories of mutual fund. One is equity funds and the another is debt funds. There are other categories as well, but when we majorly talk about two categories, it is equity and debt. We also know that equity funds provide higher return percentage. We can assume higher return percentage as an investor from the equity funds, and from the debt funds there is lower returns. Now also the reason is because equity funds are more prone to risk, there is higher risk involved, and in debt funds there is lower risk as compared to the equity funds. Now we would be talking about risk associated with equity funds, like risk associated with short selling, risk associated with mid cap and small cap companies, risk associated with dividend, risk associated with derivatives, and for debt funds, we would be looking at reinvestment risk, rating migration risk, interest rate risk, and credit risk. So let's start with the liquidity risk. Liquidity means efficiency to convert an asset into cash as and when desired by the investor. So liquidity is nothing but the efficiency. Like you have invested in any asset class, in any financial assets, maybe in mutual fund, in fixed deposit, in real estate, in stock market. Now your investment will be liquid if it is like on your wish, whenever you want, you can sell your fund and you can redeem your money back into your account. So that is called liquidity. As and when you desire, as and when the investor desire, they can convert their investment into cash. They can easily make an exit, they can easily sell their funds, they can easily redeem their money and get the cash back in the account. So this is what liquidity indicate. So what does liquidity risk means? Now there are certain funds, there are certain assets that is not so liquid, and because of that the risk of liquidity arises. Now we would just take an example related to mutual funds so that it becomes in our context of whatever we are studying. So when we talk about mutual fund, let me give you an example of ELSS fund. ELSS fund is also known as equity linked savings scheme. Now we know that ELSS fund comes with a lock-in period of 3 years. Okay, so this means that if you as an investor you have invested in ELSS fund and suddenly before the maturity period of 3 years you need your money for any urgent issues, you can't redeem that. Now, this is where the problem comes. There is lack of liquidity. Before 3 years, even if you require your money, you can't sell and redeem your money because there is lock-in period involved. So this is just an example. Another example we can take of ETF. ETF means exchange traded fund. Now those funds also suffer from liquidity risk because we know that it can be bought and sold on stock exchanges only. Now, what happens if there is lack of buyers at certain time, at certain point of time, if we as an investor, we want to sell our fund, we want to redeem the money from the stock exchange, but there is lack of buyer over there, then we won't be able to get the money instantly. So this is how the liquidity risk comes into picture. Many a times it is because of inefficient market, sometimes it is because of lack of buyers, sometimes it is because of the restrictions imposed as we saw in the case of ELSS, the lock-in period of 3 years. So all these things happen which give a rise to the liquidity risk in investment. Also, if we take a general example, like if you have invested your money in real estate, like the physical property, as you wish, you can't just instantly get the buyer and sell your property and get your money back. So it's kind of like that's a more that's a kind of asset where you are not having so much of liquidity. You have to wait for a certain period of time to get back your money, to get the buyer, to make the deal. So this is some of the examples to explain you about the liquidity risk. Now let's come to interest rate risk. Okay, one thing I have to mention which I just forgot. Uh, why is this different type of risk arising? Mutual fund, we know that it is a kind of mutual fund is a kind of financial instrument which invests in different asset classes. So mutual fund in itself is not a financial asset. Mutual fund is a way to invest in different asset classes. So we know that mutual fund invests in equity, it invests in debt funds, it invests in bonds, government securities, money market instrument, real estate, etc. So mutual fund invests in various asset classes. Now various asset classes are prone to different characteristics. They are prone to fluctuations, volatility of market, which keeps on changing the price of those asset classes. Now that leads to losses as well. Sometimes that leads to losses. Now, because mutual fund has created a portfolio of investment of those different financial asset classes, whatever impacts those financial assets also impacts the mutual fund scheme. So this is how whatever risk is related to certain investment and certain financial instrument does also impact the mutual fund investment. Okay, so this was important to understand before we move forward. Now let's see this interest rate risk. Interest rate risk arises due to the fact that increase in overall interest rate leads to reduction in prices of fixed income securities like bonds, government securities, money market instruments. So when we talk about the debt mutual funds, we know that the debt mutual funds invest in fixed income securities. It could be bonds, it could be government securities, it could be money market instruments. Now, what is this interest rate risk? Interest rate risk arises due to the inverse relationship between the price and the market interest rate. Now, let me just tell you, like when the market interest rate increases, the price of the fixed income security, for example, let's take a bond. So when the market interest rate will increase, the price of bond will come down. when the market interest rate will decrease, the price of bond will go up. Now, let me explain this with you an example to make this whole concept more clear. So, how does this happen? Suppose you as an investor, you have invested in 100 rupees bond which will yield you an interest rate of 6%. Now, after you made the investment, suddenly the market interest rate increased. The market interest rate increased to 8%. So you invested in 100 rupees bond at interest rate of 6%. Now the market rate has increased to 8%. So what happens if you want to sell now and redeem your money? If you are if you are searching for any buyer, do you think that any buyer will take from you the 100 rupees bond which will yield them 6%? Why don't they go to another market offering where they can spend 100 rupees and get 8% interest rate in return? So they will not come to you. The buyers will not buy 100 rupees bond which will yield 6%. They will rather go to the market where the 100 rupees bond is being offered at the interest rate of 8%. Okay, so this is what happens. Now, at that particular time, if you want to sell your bond which you have bought at the yield return of 6%, if you want to sell that, what will happen? The price will be decreased. You have to, the bond which you bought at 100 rupees, that price will decrease, because there is no other way that the buyer will buy bond from you at the same price which will yield them a lower interest rate. So the only way left is that the bond price will be reduced. Now suppose that the 100 rupees bond, the price came down to rupees 90. Now, do you think that any buyer will come to you because they are getting lower price? They might think of taking 90 rupees bond which will yield them 6% interest rate. Now they might think, because you are offering a lower price. So this is how it whole thing works. Just for understanding, I have explained this to you. The thing that you need to consider is that as the market interest rate will increase, the price of the fixed income securities will go down. In this case, we took the example of bond. So as the market rate increased, the price of bond went down, and vice versa. If the market rate goes down, the price of the bond will increase. Okay, so this is what we call as interest rate risk. Now let's talk about reinvestment risk. The investments made by the scheme are subject to reinvestment risk. The risk is that the rate at which interim cash flows received from the securities in the scheme are reinvested may be lower than that assumed. Now these two risks which we are talking about, interest rate or reinvestment risk, these two are applicable on fixed income securities, or we can say the debt mutual funds. So let's talk about this reinvestment and understand it a bit. Okay, so again let me explain with an example to make this clear to you. Suppose you are an investor and you purchased a fixed income security like bond. You purchased the bond when interest rate was 8%. Now what happens? The interest rate fell down to 6%. You purchased at 8% and the interest rate fell to 6%. Now, in between the coupon cash flows that you are getting, which is reinvested, now those cash flows will be reinvested at a lower percentage rate because the interest rate came down. So all the coupon cash flows which as interim which you are receiving, that would be reinvested at a lower interest rate of 6%. So this is what we call reinvestment risk. While you made that investment in the bond, you thought that the interest rate was 8%, so all the cash flows would be reinvested at the same interest rate. But what happened? That the interest rate fell down and your reinvestment is thus at a lower interest rate. So this is what we call as reinvestment risk, which is generally there when you are investing in the bond which are providing you coupons which are reinvested as cash flows and all. Now let's talk about the political risk. Investment in mutual fund units in India may be materially adversely impacted by Indian politics and changes in the political scenario in India. The occurrence of tensions and instability of politics can have an impact on the securities in which the scheme invests. Okay, so this is very normal. We all know that the securities market, the stock market, or what we say as the capital market, that gets heavily impacted with any kind of political or economical instability in the country. So we have seen that during the elections, because there is so much uncertainty on the political background during elections time, the stock market is impacted so much. There is suddenly hike in prices or it will lower down. We see that major movements in the prices. So why does that happen? Because the political instability is there due to some scenario going on. So we know that the capital market, the investment scenario, it is hugely affected by anything that is happening in the country, majorly on the economic or the political ground. So this comes to economic risk as well. A slowdown in economic growth such as increase in fiscal deficit or economical instability may adversely affect investment in the country. We also know that there are foreign portfolio investors who invest their money in certain countries with a belief that this country is going to develop at a faster pace. Now, what happens if there is any kind of economical instability, if the foreign investors think that this country is not going to be good for business purpose or making investments for growth of investments, so there is kind of instability in the country which is affecting the investment. So affecting the investment is affected by any kind of economical scenario, economical instability as well. Now let's come to foreign currency risk. So right now we talked about foreign portfolio investors. So as the foreign portfolio investors, they invest in mutual fund units as well in India. Now what happened that when they are redeeming their money, it would be translated into their own currency. And the currency movements, the difference in the currency prices, the value, that leads to the foreign currency risk, because we know that the currency is also prone to movement and changes. So maybe what the expected growth return was not the same after being getting converted into another currency of another country. So this is what we call as foreign currency risk. Now let's come to settlement risk or counterparty risk. Specific floating rate asset may also be created by swapping a fixed return into a floating rate return. In such a swap, there is risk that the counterparty who will pay floating rate return and receive fixed rate return may default. Okay, in simple words, counterparty risk is that two parties are involved. For example, two parties are involved. One is you and one is another person. Now, if that another person is making any kind of default in the agreement which you made on the basis of any kind of investment, that default risk is referred as counterparty risk. Now, this example is given of a swapping investment. So sometimes what happens that one particular investor is having a fixed rate of return, another is having an investment in a floating rate with a floating rate of return. Now both want to swap their investments. So fixed return will be swapped with floating rate of return. Now what happens if the counterparty or the another party make default or does not do the same or does not make go throughout the agreement as promised? So there is always a counterparty risk involved. This is mostly in the case of derivatives. Mostly the counterparty risk gets seen because in derivatives, what happens, there are generally parties involved who are making contracts for future period of time. For options, futures are there, swaps are there. So counterparty risk is more visible when we are trading in derivatives. Now let's come to specific risk factors. This is equity related risk. Whatever we learned here in general, now we have to categorize it like what all risks are related to equity and what all risks are related to debt funds. So let's talk about equity related risk. We know that equity has higher risk as compared to the debt funds, and this higher risk is also due to higher volatility. Volatility means there is a lot of changes or fluctuations in the price movement of equity and equity instruments. The liquidity of investment made in the scheme can get restricted by trading volume and settlement period. So also there is restrictions in terms of trading volumes. Sometimes there are certain companies, certain shares of companies which are traded quite heavily, which are having lots of buyers and sellers, but at the same time, on the same listed stock exchange, there are certain companies which are not much in the view of buyers and sellers, and there is very less trading going in those companies. So there comes the risk that there would be inefficiency in the market for certain companies, transactions, and all. And then there is settlement period. Settlement period is also creating a kind of equity related risk when we are talking about transactions in this particular field. Now, other than this, there are many other factors which are affecting equity related investments. Now, those factors are interest rate, currency rates, change in policies of government, taxation, political, economical scenario, specific sector. So, you just see that whether we talk about political scenario, economical scenario, the currency scenario, policies being made, sector, industry, everything is almost impacting a lot to the equity instruments, to the capital market trading. Now let's talk in detail about some of the risk associated with equity instruments. The first one is risk associated with short selling. Short selling is the sale of shares that the seller does not own at the time of trading, rather borrows and return back by buying at lower price. The inherent risk are counterparty risk and liquidity risk of the share being borrowed. Now, first you have to understand what exactly short selling is. So, as mentioned, like in what happens, let me just explain you this the whole concept of short selling. It is very simple, yet people think it's quite complicated, but it's very simple to understand. Let me just explain. Like short selling, in short selling, what happens? Suppose you are an investor, you don't have any shares with you. Okay, you don't have any shares with you. Now you want to borrow certain shares of any particular company, which you think that this company's shares will go down in the recent time. So you think that maybe this company's share is trading at rupees 50 right now, but within 10 days, within coming 10 days, this share prices may go down to rupees 30. You believe this, you make an assumptions on basis of your analysis and readings, whatever you say, but you believe this, that the share prices will go down of a particular company. Now what you will do, you will borrow the shares of those companies from the broker. Okay, so for example, you have borrowed 100 shares of XYZ company from a broker. You sold those shares in the market at rupees 50 each. Okay, so 50 is the current market price of that share, and you sold at 50 each. So now 100 shares sold at rupees 50 each will provide you rupees 5,000. Okay, you have got 5,000 rupees in your hand. Now what happens that the prices has dropped as you expected. After 10 days the price dropped to rupees 30. Now what you did, you bought 100 shares again at rupees 30 each. So 100 shares at rupees 30 each, you have paid rupees 3,000. Okay, so you sold at rupees 5,000, but you bought again at rupees 3,000. So 2,000 the bracket is your profit, and the 100 shares that you borrowed from the broker, you return back to the broker again. Okay, so this is how the short selling scenario works. There would be certain charges which of the borrowed fund, that charges would be deducted. After that, whatever would be left would be your profit percentage. So this is the whole concept of short selling, but there is also certain risk involved. So the first risk we can understand is that the investor assumed that the prices will go down. He was very sure about it on the basis of the analysis that he made or the information he was having. He was sure that the prices will go down. What if the prices didn't went down and it increased? So that would create a situation of loss. So there was a risk of uncertainty. Again, there may be liquidity risk, counterparty risk. This also applies to equity instruments. So this kind of risk is always associated with short selling, and it's not like what we say a fair investment, a fair trading practice. Now let's talk about risk associated with mid-cap and small-cap companies. Investment in mid-cap and small-cap companies are based on the expectation of faster growth and increased value and earning as compared to large-cap companies. However, such companies may not achieve the expected growth, higher risk in terms of volatility. So the top 100 company in terms of market capitalization are referred as large cap companies. Below that, whatever comes are under the category of mid cap and small cap companies. Now, what happens that large cap companies are those companies which are well established. They are having large branches and networks, well reputation, and good growth and profits in the business for consistently for many years. So those are the large cap companies who have established a certain position in the market already. Now, after that comes mid-cap and small-cap companies which are having a larger scope of growth now. So investors, what they believe is that mid-cap and small-cap companies are expected to grow at faster rate because large-cap companies have already grown a lot. So they have already got a certain position in the market. Now left is mid-cap and small-cap companies. So some of these companies which are providing, which are showing good balance sheet, good income statements, those are believed to provide a faster growth rate, a more valuable earnings in the coming years, and an increased valuation of the company in the market. So these all expectations make the investors invest their money in mid-cap and small-cap companies. But one thing we need to keep in mind is that large cap companies are more safe as compared to mid cap and small cap because we are investing in mid cap and small cap with the assumption that there is a scope of growth. What happens if the company is not going to go well? Because it was our assumption, it was our expectations. Maybe that the companies are not going to perform well in the coming years. So the profit that we expected that may go in loss as well. So here you need to keep in mind that as compared to large cap companies, mid cap and small cap companies carries higher risk. So when we talk about risk criteria, the highest is in small cap companies, then the risk is there in mid cap companies, and the lesser risk is there in large cap companies. Okay. However, such companies may not achieve the expected growth. As I said, higher risk in terms of volatility, of course. Now comes risk associated with dividend. Dividend is due only when declared and there is no assurance that a company may continue paying dividend in future schemes. So we know that mutual fund schemes also provides with two options. First is growth option and another is dividend option. So does the dividend option, your investment in dividend option assures that you will be getting continuous dividend at a certain periodic time? There is no assurance as such. Dividend is only declared when the companies are going in profitability. Also, if the companies wish to declare dividend out of their profitability. So there is not any fixed term that you need to be paid dividend at certain interval because you have invested in a dividend fund. As and when it is declared by the company, it would be paid. But there is no such certainty. Okay. So this is what we call as risk associated with dividend. And this also affects the performance of the scheme because investors, when they invested in dividend fund, they thought that they would be getting continuous dividend. Now, if the companies are not declaring dividend because they are not earning profitability or they don't wish to declare dividend at that particular point of time, so the dividend won't be passed to the mutual fund schemes and thus the investors won't be getting the dividend. And in such a case, what would happen that the investors would lose their trust on the scheme and thus the performance of the scheme would be badly or adversely affected. Then comes the risk associated with derivatives. Derivatives are those financial instruments which invest in underlying financial asset. Okay, so I talked about the contracts being done in terms of futures, swap, options, that is all under derivatives. Now, derivatives are the more riskier one as compared to the equity. Also, derivative is the more riskier one. So the mutual fund schemes, they may invest in derivatives, but there is certain limit, certain extent that is permitted by SEBI MF regulations. So that limit has to be kept in mind. And derivative investment are majorly prone to counterparty risk and liquidity risk. We talked about this counterparty risk and we saw that how it was applicable to derivatives as well, because parties are involved which may default. There is future contracts set, so agreements may be maybe the party won't go by the agreement. So this is all type of risk involved when we are trading in derivatives as well. Now let's talk about risk associated with debt instruments. So first is rating migration risk. Fixed income securities are exposed to rating migration risk, which could impact the price on account of change in the credit rating. Okay, so fixed income securities are provided with ratings by the credit rating agencies. Now, those credit rating agencies provide rating to these securities on the basis of their financial position, their repayment capability to the investors. Now, if this rating is good, that shows that it is more safer to invest in particular bond or particular debenture as compared to those which are provided with lower rating. So this rating is also to help the investor to be aware that where it is invest to save their money, to invest their money, where it is safe to invest their money, where it is more riskier. Okay, so this is why rating is provided. Now there is rating migration risk. Maybe as an investor, when you invested in a particular bond, the rating was quite good of that particular company that issued bond. But later on, what happened? The rating was degraded due to any uncertain event, any scam happened, any fraud happened, any liquidity crisis appeared in the business. So, because of any reason, the rating was downgraded. So, this is what gave a rise to rating migration risk. Credit risk. Fixed income securities are subject to the risk of an issuer's inability to meet interest and principal payment on its debt obligations. So we see that fixed income securities become an obligation for the companies or the government who issues the bonds and the debentures to the investors. They have to pay a certain amount of money to the investors after a certain period of time. Now, if they default on interest and principal payment, that is referred as credit risk. If they become unable to pay back your interest and principal payments as promised, so this is giving a rise to credit risk that default may happen. And this is why we also go by the ratings. There are different kinds of rating being provided to the corporates, the bonds which are issued by the corporate companies, from AAA rating to AA, B rating, etc. Now, interest rate risk and reinvestment risk. So we already learned about this in previous slide about the interest rate and reinvestment risk. Those are also applicable to the debt instruments. Here comes managing risk. So what happens that in mutual fund scenario, how are the fund managers trying to manage this various kind of risk? So starting with managing market liquidity risk. Now this is managed by creating a portfolio which has adequate access to liquidity. If you see in any mutual fund scheme, there is a portfolio in which there are different companies in which investment has been made in different proportion, but you would also see that there is certain exposure to cash as well as money market instruments. And that is because to maintain liquidity, certain exposure is always made to cash or short-term instruments or money market instruments to maintain the liquidity as and when required. Managing credit risk. Credit risk, we already learned that it is associated with fixed income securities, and how it is managed is that whatever the debt funds, the bonds, the debentures are chosen to be a part of the mutual fund portfolio, that should be having a good credit profile. So a proper credit research process is done, including analysis and due diligence. Credit rating is checked, which should be good, so that there is no defaults or there is no problem in paying back the investors their amount. Managing term structure of interest rate risk. The investment manager actively manages the duration based on ensuring market condition. As the fixed income investment of scheme are generally short duration in nature, the risk is expected to be small. Okay, so the term in terms of interest rate risk, we saw that generally when the interest rate changes, the price is affected. The price of fixed income securities is affected. Now, longer would be the term period of fixed income securities like bonds and debentures and all. Longer would be the term period, higher would be the risk of change in interest rate. So generally how this is managed, it is kept for short duration, because if there would be short duration, there is lesser chances that the interest rate would be changed a lot, and thus the impact on prices would be less. So this way the risk can be managed. Managing rating migration risk. The endeavor is to invest in high graded quality securities. The due diligence performed by fixed income team before assigning credit limits and all. So this is also talking about how the due diligence process. Due diligence means proper verification of the documents, proper check of the income statements, balance sheets and all, to know about the company's financial position, how strong it is, repayment capability and all. So looking for high graded quality securities and doing a proper credit review and monitoring is the way to manage the rating migration risk. Now let's come to factors that affect mutual fund performance. So we already know that different asset classes like equity, bonds, debentures, money market instruments, they are having different characteristics which affects mutual fund performance. In the same way, there are different fund managers managing who have different approaches and strategies. We know that there are two types of strategies that is followed by fund managers. It can be passive, it can be active strategy. In active strategy, there is more involvement of the fund manager in terms of rebalancing of the portfolio as and when required according to the market. However, in the passive strategy, they just follow the index and they try to achieve the targeted return percentage. So there are different styles which is followed by the fund managers which impact the mutual fund performance. And you must have also seen on the website, on the AMC's website, when you go, there is fund manager's name mentioned, their experience year, their details of managing particular fund. That is to give the investor an idea about the fund manager, how well it is, how well he or she is in managing a particular fund. Now, this one is also very important, systematic and unsystematic risk. Generally, this question is repeated, so you need to keep this in mind. In your MCQ, it would be asked most probably. So, systematic and unsystematic risk. The risk that impact the specific company. Okay, so if there is a risk that is impacting one particular company only, that risk is referred as specific risk or unsystematic risk. However, if there is a risk that is impacting the whole economy, the whole market, not just a particular company, but the whole set of sectors, the whole companies and the whole market, so that would be referred as systematic risk or market risk. Okay, you can take the example of recent COVID-19 case, which does not impacted only one single company. It was impacting the whole world. It was impacting the whole economy. Businesses were shut down. There was lesser investments happening. So that is how the entire economy was impacted. That was a kind of market risk. However, if a company is indulged in a kind of fraud and suddenly the performance goes down, so that would be what we call as unsystematic risk or company specific risk. Now the company specific risk can be reduced through diversification, and this is the reason why we see that in most of the mutual fund schemes portfolio, it is well diversified in different companies in different sectors, so that even if one company does not perform well, there are other companies which might perform well and balance the return percentage of a particular scheme. So there should be a well diversification in different sectors in different companies as well. Now that is also a way to manage the company specific risk. So the unsystematic risk or the company specific risk can be reduced through the process of diversification, and hence it is also referred as diversifiable risk. Now from here you can get an idea that the market risk cannot be diversified, and thus the market risk or systematic risk is also referred as non-diversifiable risk. Okay, so again let me repeat it for you. Systematic risk means market risk and it cannot be diversified. Unsystematic risk means company specific risk and this can be diversified. Okay. Thank you for watching. Keep up the support and do not forget to watch part 2 of this particular chapter.